Okay, do you want to learn Elliott Wave theory? Well, if so, consider joining the Green Star Trading Patreon for just £10 a month at Tier 2 or £15 a month at Tier 3, and you will get access to this 11-part Elliott Wave series teaching you Elliott Wave from scratch in a really simple and easy to follow manner. And you'll also get access to my deep dive series, which shows you how I apply Elliott Wave from scratch on a new asset. Also the My Chart series, which is still ongoing and shows you all of the various tools and indicators I use on TradingView and how to set them up. And also my trading playlist, where I show you how I use my method of the standard trade setup, what I call the STS. I also cover some trading psychology, risk management. There's also a whole host of educational materials available on the Patreon as well. And that's just the content, guys. There's a lot more to it than that. If you actually do become a member at Tier 2, you'll also get access to the public Discord, where there are hundreds of members discussing ideas every day. You'll also get access to the weekly live streams, where you're pretty much allowed to ask me anything within reason. And if you want me to cover a certain asset, I'll look at it for you. If you want me to even look at your own work, your own Elliott Wave work, I'll dissect it and look at it for you. These things often go on 4, 5, 6 hours sometimes, and we have a bit of a laugh as well, and you're free to ask me anything you like within reason. If you want more than even that, though, you can join Tier 3 for £15 a month, get everything I just mentioned, but you also get access to my monthly dividend calendar and stock rating system, which looks at high quality stocks with good company health, good value, paying a good yield, worth holding, and that's for the investors out there rather than just the traders. Now, if none of what I've just said, the videos, content, the Discord, the live streams, the calendar, all those things, if they don't appeal to you, and you just appreciate the work I'm already doing on YouTube and want to support me, you can pay us £5 a month and still bag yourself one exclusive video each week. Alright guys, thank you for listening. Now let's get back to the video. Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, it's time to have our weekly look at the stock markets. We're going to be looking at the SPY, we're going to be looking at the NDQ as our proxies for the S&P 500 and the Nasdaq. We're also going to be looking at the put to call ratio and the VIX as well today. Okay, so first things first, it is swelteringly hot here in the office at the moment. I've got the fan running in the background, as you can probably hear. I apologise for the noise. I've also got the window open, so if you hear the neighbour's dog barking, that's why. And if I start to have some kind of absolute breakdown and nothing seems to make sense, it's probably because I've got heat stroke, so just bear that in mind. So I'm going to do the best I can to get through this, but apparently it's going to get even hotter as the week goes on here in the UK. People are saying about 32 degrees Celsius and stuff like that, apparently. I honestly consider that a threat to my national identity. I don't think I can be English and survive 32 degrees Celsius at the same time. Something's going to have to give, but we'll see what happens. Either way, let's get on with it. We're going to start with our Elliott Wave counts, then we're going to do some classical analysis, then we're going to look at the PCC and the VIX as well. So, we are in a downward trend. Yeah, no shit, Sherlock. And we've been saying for a while now, if we just bring up our regression channel here, we've been saying for a while that we see it as a W, X and a Y. Okay? It's coming down as a double zigzag. Doesn't have to come here, it could probably stay inside the channel. This channel could become more severe if the price action becomes more severe, as it is a regression channel. It looks back at all of the swings in price data and gives you a mean and then two lines which represent two standard deviations from the mean. So it adjusts the price over time, and as you can see we're trending lower. So I have a primary one top here and we're working on a primary 2. Now a primary 2 could be a 50% correction, it could be shallow, 38.2, it could be deep, 50, it could be deeper, 61.8, it could be deeper still, 78.6, or it could be even deeper still and be an 89% retracement. Okay, all of those things are on the card, and for as long as we remain in a downtrend, in a negative bearish, in a very bearish and negative state, and our momentum indicators continue to support a downward move, and our moving averages are rolling over, and everything's looking awfully bearish, until that reverses and we see some kind of 5-wave move wherever it comes, whenever it comes, that breaks trend and then comes back as a free. That's going to be most likely the low, and that's going to be a tradable setup when it comes. Now if you're lucky enough to actually get the low and then the first move back and the move back here, first higher high, first higher low, then you're doing brilliantly, but we have to wait for it to come first. if we want to go long, that is. And being as I think we're going to be entering a primary 3 once this is complete, we are most definitely going to want to be going long. Alright, and so let's come down to the 4 hour and see what we can see here. Now we could be done, right? We got our first zigzag, A, B, C for our W, A, B, C, 5 waves here, and a flat for our X. 1, 2, 3, 4, 5, A, B, C, another flat for our B here, if this is in our Y, however. And now we are continuing 5 waves down to get the C of the Y of the 2. Now that C could be here and we could be finished, which means the Y would be here and the 2 would be here. We've come back to the edge of the regression channel. We've extended the C beyond where the A completed. It is not truncated, it's just very short. Okay, and the C can be extended, it can be short, the A can be extended, the A can be short. So we've done technically enough to find a low here, but it's not particularly convincing, I don't think. So let's remove this regression channel, bring up this pitchfork for the moment. It's not the best fit. If I get a better fit on the NDQ than I do here, and I get a better fit here with an original pitchfork than I do with the mod shift or the shift. So we can see that we've come roughly to the median line. We've treated the 38.2 as support, and then that later became resistance. We've moved back to the edge of the pitchfork on a couple of occasions and continued lower. Maybe we're looking for the median line and a back test and then the median line again. All of these things are possible. Now let's just take for a moment, I'm just going to take the dominant low rather than the orthodox low for a moment and see if we can get a nicer fit, because you have to remember the pitchfork is not an Elliott wave tool, it is an algorithmic tool essentially. Now if we do take the dominant low, all of a sudden this looks neater. We contain price on the edges. We seem to channel better with the 38.2, back test here, and test the 38.2 to the downside. So maybe we should look at it like that. So I think that's a nice fit. So I'm going to save the pitchfork in that position using the dominant pivot rather than the orthodox pivot for the count here. Right. Easily contains all of the future price data, potentially lower. So if we haven't completed the C of the Y of the 2, then it's far more likely that we have either completed the 1 or not quite there yet. With 1, 2, 3, 4, and 5 to get the 1, then comes the 2, then 3, 4, and 5. Now I haven't placed these, we won't know how far we can project the 3 until we get the wave 2 retrace, then we can project the 1 from the 2 to the 1, 6, 1, 8 and beyond to try and find the 3, but for the moment it would be all guesswork. So what have we got on the chart in the meantime? So it's possible we're done, okay, for a 1 or even the C. We have gaps in the chart which will get filled. Okay. Well, most likely will get filled. So the question is, do we rally now to fill them in a 2 before continuing lower? Or are we going to get these filled when we complete this correction and come back up in the next bullish wave? Either way, I think they're going to get filled. I would lean towards them getting filled in the shorter term as part of a corrective move before heading lower. Okay, if we do see an impulse come out clearly and we break this downward trend, that could be the low in place. But that's what we're going to be looking for, that no matter where it comes, whether it's now or whether it comes much later. Okay, that's the count. W, X and a longer Y. We've done the A, we've done the B, we're in the C. It could be extended, it could be shorter, we just don't know. If we look for parity using a trend based fib extension tool here, we can see that roughly around here at the median at 341 spot 68. I say again 341 spot 68. That would be 1-to-1 for the A equals C of this zigzag pattern here. Now the A to C parity matters more than the W to Y parity. The individual parity of the subwave zigzags has a stronger relationship than the individual zigzags within the greater double zigzag pattern. It's the individual relationship of parity between C and A which is stronger, but it is only a parity relationship. It doesn't have to happen and frequently doesn't. It just tends towards it, that's all. Excuse me, I'm just going to have a quick drink. Got quite a scratchy throat from the pollen. It's hay fever season for me as well. Pouring misery on top of the heat. Grass pollen. Only lasts for about a month or so. It will dissipate. Okay, so that's the count. Let's switch off the count for a moment. We've looked at the one-to-one relationship for the A to C here. We've looked at our pitchfork. We know that we're in a downward trend from our regression channel here. So let's look at some... Well, let's do some classical analysis while we're here. Then we'll look at the Nasdaq. We'll do it in sequence instead. So let's bring up our VRVP. Let's bring up our moving averages. Okay, and then we'll bring up our indicators in a bit. Come out to the day time frame. Right, we are below the 250 exponential moving average. We dragged the 60 through it. That formed the recent low. That was a death cross. That always signifies, I say always, 90% of the time signifies a low coming into the market. Shortly after the death cross occurs, it was a low. It bounced, but it wasn't the bottom. It was just a temporary low. The 250 has now rolled over. The 60, 10 and 20 are all trending lower now with a series of lower lows and lower highs. Okay, so bearish all round. But things were always darkest before the dawn. Last time we broke the 250 on the daily time frame was during the March 2020 lows here by quite a significant amount, and then we also did it in the taper tantrum during the power pivot of late 2018. That's when we were raising rates the last time. We were in a rate raising cycle, and it all went wrong, just as this one will, because there's no possible way it could be done, in my opinion. Prior to that, to the downside was during the GFC. These were upward back tests, testing for support. There were smaller breakdowns, significant corrections. We had one also when Trump was elected around 2016, March, February 2016, and then that was it. There was no stopping the market after that happened. So we can see that we've already broken the 250, so we're into a more significant correction, a larger wave degree correction than anything we've seen in the trend since the March 2020 low. That's why I'm calling it primary degree. If we come out to weekly, you can see how we are not as severe as some of the corrections we've seen on the weekly time frame yet. For example, the March 2020 low was pierced the 250. Okay. Also, obviously, the GFC did the same with a significant move below it. We are still shy of it at the moment, so this could be potential support. Right, 250 exponential moving average, which is somewhere around currently around 246.47, but it will continue to come up to meet us over the coming weeks. So let's look at some structural support. Right. Excuse me. We've got the 250 here. We mentioned our moving average. We've got the previous high. Okay, the February 20 high. 338.05. Not all that much to shout out about in the volume profile here. Then we've got this high here and this high here. Moving through these two, we've got a back test of it here, and we've got resistance again here and support again here. So this is an incredibly strong support level here, around 295.70. So that would be a much deeper correction. We can see some volume in the profile here, more trading going on in that region. Then we've also got a 78.6% retracement, which is the 274.64. Now that should be in a different folder. Let me just find that one. That's it. That should go in with our targets folder. Excuse me. Let's do that now. Which horizontal ray is that? Stands to reason it's going to be that one. Yep. Okay, and I put the wrong price label. Did I? I think I did. Wait a minute. I've got myself all sorts of confused now. No, that's right, 274 in there, that's fine. Okay, no problem. Okay, I did not mean to put that other one in there. That's there, isn't it? That's fine. So, excuse me. Like I said, brains melting in the heat. Bear with me. 338.05 is a structural support here, and really strong structural support is here at 295.70 with some serious price action, some market acceptance in the volume profile here to back it up. Now let's look at our fib targets then. 50 comes in around the, which is the blue line at 349.46, comes in around the 250-day exponential moving average at the moment. That could be some pretty strong confluence if they're overlapping by the time we get there. 61.8% would be 318.23. This would coincide with breaking the 250, probably about the same margin that we did in March 2020. A more significant break of it and push down would bring us into this point of control, into all of this market structure. If we bring that support back up around this 295 area, into all of this prior noise, and into the 78.6% retracement. Okay, so there's plenty of support below us, which is yet to be tested. We're still essentially, being absolutely honest, we're still essentially in thin air at the moment. A lot of thin trading here. Look, see, in this little gulf. So if we are having a more significant correction, and my own personal account suggests that we are, we're going to come into some actual market support, some actual structure to test at some point. So potentially a little bounce and then push deeper. Now I could be wrong, and that could be enough. Right, could be enough, and then we're off. Okay, so now let's bring up our indicators here for the moment. We stay on the weekly for the moment. Okay, now we've got our, bear with me. Okay, looking very bearish on the ABV actually now. That's not far off the March 2020 lows, with a lot further to come in price. We've got some bullish divergence on the RSI currently between this low and this higher low, but it's only between a low and current price, not an established low. So it's not true divergence unless we get a reversal, and we haven't got signs of it being a proper reversal yet. A few more days price data required. MACD is looking very bearish, with trading on the weekly, I say trading, that's just a force of habit. We are currently at roughly the same levels where the MACD bottomed out during the March 2020 low, so it is a very bearish sell-off. Same with the RSI here, not as severe. Now if we come down to the daily time frame, we can see we've had some more volume as we've come down in price. This is the norm for when the SPY gets cheaper, volume spikes in these lows. It's just been the norm throughout this whole bull market, and it's starting to increase. Well, we've seen a little decrease from this move here, but we're still getting larger spikes during this corrective move than we have during all of the bullish phase prior. Okay, as it becomes cheaper, more of it gets traded, right? Greater volume. Long way down yet to come in the OBV on the daily time frame. The MACD is still a long way off that March 2020 lows. More bearish picture on the weekly time frame, or signs of it being a more significant correction. And we've got bullish divergence on the day time frame, but I mean, let's just come in and have a look at this, because shorter term divergences are stronger than longer term divergences when we're dealing with the day chart here. So we can see how we've got a pretty significant divergence here between these two lows in the RSI, low and a higher low. Now that was this low and this lower low, and it was followed by this completed C wave, right? An impulsive move higher. So that's what that was the herald of. How much we can really read into the trend to this low, like that, and the bullish divergence here, I don't think that's arguably as strong. We went from oversold to overbought. If we saw shorter term divergence between lows here on the RSI supporting lower lows here in price, higher lows in the RSI over the shorter term like we saw here, that would normally be the herald of a bounce that is coming. But sometimes a push down into oversold is all you need. You won't necessarily always get that bullish divergence. As I pointed out before, the March 2020 low was quite a deceptive low in terms of giving you any forewarning. The RSI was the only thing that was giving you forewarning. Everything else was pretty bearish. So there's your classical analysis for the SPY. We've looked at our support levels below. We know we're in a downward trend. Until we see it broken, we're going to assume that the trend is your friend, and we're going to keep continuing lower until we see a reversal. So now let's come over and have a look at the Nasdaq. No, we can't get volume here on the NDQ, but we can still look at the count, and we have an alternate. We we have an alternate to deal with as well. Now, primary is the same, so let's not go over the same ground again. It's primary 1 into primary 2 to come. Okay, WXY subdividing pretty much identically to the SPY. So we don't need to waste our time with that. We are, however, down lower in the Nasdaq. We've already come through a 50% retracement from the March 2020 lows, already broken it. The 61.8 isn't too much further below us. Okay, let's just have a quick look at that price for the golden ratio. Is at 10535 spot 97. 10535 spot 97 is where the golden ratio is. Now we could continue lower down to the 78.6, down to the 89. That's all possible depending on how this double zigzag unfolds. Now, like I said, we've done enough here as well. We've done the C's gone beyond the A, where the A completed. B and C could be a short C, and if we get a huge impulse out of here, that's a possibility. However, we should assume, while the trend is still down, that we are going to continue to see this downward trend. Now, our pitchfork takes a much more aggressive move, so this could be a case that this regression band will become more severe over time if we get a significant move lower. Now let's just have a look at these pivots here. So this looks a bit nicer than it did in the SPY, off of a orthodox pivot rather than the dominant pivot. We can see a test of the median line here, test of the out of bound. Probably coming back to the median line again, back to the out down, median line again. This is quite normal. If it gets really nasty, push for the other end of the pitchfork. Okay, then back test it from above, then find your first level of support, and then probably move higher. So it could get ugly. Alright, that's always a possibility. Let's just have a look how this has been channeling. So we saw similar activity here, the 61.8 being support, 38.2 being support, then being tested from underneath as resistance. It does seem quite accurate at the moment as the price continues lower. So a break of this structure, or the regression band structure, channel structure, with an impulsive move out of it, that could be signs of at least a temporary low. It could continue to morph into a more complex correction from there, or it could be the low. Free wave move back and off you go. Alright then, so let's look at an alternate idea then. Okay. Alternate idea has this, because of the way it's channeling, which is more neatly, it's kind of channeling as an ABC, as a zigzag. It's not perfect. And I have a truncation in this count at the high here. That's just an issue we have to deal with anyway, but I have a 1, 2, 3, 4, 5 and a contracting leading diagonal in an A. Short, sharp, super fast zigzag in a B, and then 5 waves down. 1, 2, 3, 4. They do alternate, but they're not very pretty. One's a flat, one's a sharp zigzag, and to 5 into C. A, B, C complete, roughly around the 50% retrace, and off you go. So it could be over. That's our alternate count. Now, I'm not particularly fond of it, to be honest. I think it breaks down better as a series of zigzags. Yeah. We don't seem to have the subdivision in place to just call it a zigzag. You know, from, as an impulse and an impulse, we get this diagonal. I'd rather look at it as a series of three-wave structures, personally. Okay, so that's the Elliott wave picture. Like I said, it's the same as in the SPY, so we won't waste time looking at that. We're expecting the same thing, doing the same thing. So where are we with our moving averages on the weekly time frame? Let's have a look. Now the 250 was never broken in the March 2020 low. It was not broken in 2018 temper tantrum, and it was not broken during 2016. It was last broken during the GFC, and prior to that it was broken during the tech bubble. So the Nasdaq has been stronger the whole time. So if we were to continue the same behaviour of bottoming prior to the 250, this could be it. And this could be a three-way structure complete, and we rocket out of here. Okay, my primary doesn't support that, because the way I'm looking at the SPY at the moment suggests either, like I said, you got that potential for a C, but it just doesn't quite feel right. It feels like this wants to be another zigzag. So that would be very bearish, looking at the history of the Nasdaq here. Let's bring up our indicators. And let's bring up our MACD here. Let's get some perspective on this thing. So, on the weekly, this is the most bearish momentum we've seen. Right, we are so far below the zero bound, we've been taking an absolute pummeling. Right, much worse than it appears on the SPY. Very, very negative momentum. If we look at the RSI on the weekly, we do have that bullish divergence again in the shorter term time frame between low and higher low, but we are right back at where we were in March 2020 and all the way back in December, in the GFC during 2008, and then before that in the tech bubble. We're not quite as oversold on the weekly as those levels, but we're getting pretty close. Okay, it feels very wave 2-y to me, like a nasty wave 2, and that's what I'm counting it as, just a primary degree. So that's basically the picture for the classical analysis for the NDQ. I don't think there's anything else to analyse. All of our volume analysis and that is on the SPY, and whenever we find support in the broader market, we're going to find support here in the Nasdaq as well, so I just expect that to be the case. Now let's come over now and have a look at the PCC. So let's have a quick look at this, a quick think about this. I pointed out this descending trend line from this high to this high to this high, not really this high, and now we're currently breaking it slightly. We are still in a downward trend. High, low, lower high, higher low in this case, lower high, higher low, lower high, lower lows, lower high. This high is still below this high, so we have got a series of descending highs. Now we could break out and do something like we did back here, okay, but this could be synonymous with the market getting towards its lows. Now these things do tend, so that it does appear to be a bit of a contradiction, doesn't it, with what I'm saying, because from an Elliott wave picture we don't look complete. From a more classical analysis picture, we've done plenty of damage, plenty. Broken major moving averages, gained some massive bearish momentum, reached oversold conditions on larger time frames, pushed back up into fear and panic region in the PCC here. We seem to have done a lot from a classical analysis point of view. Now this thing tends to bottom, or tends to peak with the lows in the market. Right. We've got on our chart here on the SPY a little folder we can open, and I've gone through this before in a previous video, I can't remember exactly when it was. VIX and PCC extremes, going all the way back here, and we pointed out the highs where the peaks of the PCC and the VIX were, and how they link up with the lows of the market. Now the VIX here turned out to be a leading indicator on 1, 2, 3 times, and the PCC was actually lagging, just slightly lagging the VIX, and slightly, but pretty much nailed the market low. Right now, in this case, the VIX was leading again, and the PCC was leading again. In this case, the VIX was leading, and the PCC was spot on. And in this case, they pretty much overlapped in the March 2020 lows. So they're pretty accurate, would be my point. Whenever we get a peak here, that's the market low. That seems to be very normal. So now let's come in and have a look at the VIX. Now, what's interesting about the VIX, right, is we've had some pretty extreme readings in the past, like the GFC and the COVID lows, right, getting up into 80 territory. Now, all the other major lows we've witnessed during the bull market have all come in this range here. Currently, we've nipped into it, but we're now currently sat below it. I find it quite odd that we haven't seen a further increase in volatility yet. Now people could say, oh well, the market is pricing things in nice and gradually, plodding itself along. Well, we can't have that kind of non-reactionary fundamental view when we pointed to world events in the past. I mean, we've had a pandemic followed by a European war and followed by massive inflation. Well, not massive, but significant inflation, and we're not seeing that kind of volatility, are we? Which is a little peculiar. So maybe we're going to have another explosion, or maybe we just need to get into here a little bit before we can bottom the market. Maybe things aren't as bad as they appear. Yeah, there does seem to be a little contracting pattern here at the moment. I'm not sure it's a triangle, but I don't really think you can do it. Well, you can't do Elliott wave on this. It's just noise. But that doesn't mean Elliott wave structures don't form. It just means that there's no cohesive pattern, no cohesive overriding structure. What we had was a series of descending lows in the VIX, and from 2017 a series of rising lows. Okay, overall declining volatility, overall rising volatility. So I would still expect the push back into this territory at least to come. So it still feels the same. It feels like from a classical point of view, from classical analysis point of view, we've done plenty of damage to the market. We've done plenty to bounce, to maybe even bottom. From an Elliott wave point of view, it doesn't quite feel complete structurally yet. Okay, and I guess that's really where I'm going to have to leave you guys for the stock market for the moment, until we see something more telling. Some kind of reversal, some kind of break of this downward trend. We're going to have to, I think, stick on the side of the bears until proven otherwise, and expect further downside to come over the coming weeks and months, and seek out some lower targets. What that means for the PCC, we'll have to wait and see. We could come up into this kind of range and we could just top out, right? Topping ranges are not particularly long. What was that? December 18, November, October. There's only a month or two at the highs here. Normally, sometimes less. Most of the time, significantly less. So that would be very unusual behaviour. So I wouldn't expect to see that. We have had these double peaks of periods of volatility. There's the taper tantrum. There's COVID. So you don't know quite what you're going to get in the future. You could get some kind of double peak here between a temporary bounce, a significant rally, a push to new highs even, and then another collapse into another low. You don't know. We'll have to wait and see, won't we? But traditionally, the PCC peaks tend to mark the lows in the market. We'll have to wait and see what that means. Alright guys, thank you very much for joining me on this technical analysis of the SPY and the Nasdaq. If you're new to the channel, if you like what you're seeing, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below, and as always, if you are a Patreon subscriber, thank you massively for your support. It is greatly appreciated. If you're interested in joining the Patreon, there's a link in the description box below. Head over, have a read of the tiers, and see if there's anything you like, and feel free to sign up. On that note, I just did a video, Patreon exclusive only, looking at the Brave New Coin Index for Bitcoin, the BLX, where I looked at the entire price history of Bitcoin and laid out an uber bullish case, and broke it down over a good best part of an hour of exactly why I see what I see. So if you're interested in that kind of thing and you want access to that video now, the only way you're going to get it is if you join the Patreon. So there you go. Also, if you're not following me on Twitter yet, please do so, as I always announce a video here. My brain's not working. I always announce new videos posted on YouTube, on Twitter. There you go. Alright guys, take care of yourselves. I'll be back with you soon, but honestly, until this heat dies down a bit, I think I'm going to just try to avoid the office for the next few days. I've got the live stream tomorrow, which is going to prove to be deeply uncomfortable, I think, but I'm just going to have to muscle through. All the best guys, take care of yourselves, and I'll speak to you soon. Bye bye.